Hi, this is Lara at Elliott Wave Gold with an extra video update for you again after the session dated Tuesday 9th of August has closed. I still expect that there's an upward trend in place and the target for primary 3 remains the same at 1582. However, I want to see a new high by any amount at any time frame above 1349.25 before I'm going to have a reasonable amount of confidence in that expectation, because there is still some reasonable bearishness about from volume. Because of bearish volume, I'm going to publish an alternate today, and as I go through this video I'll quickly outline for you another alternate idea which I'll be charting and publishing tomorrow. For now, let's just stick with the one alternate today. Because of bearish volume, it is strongly advised that members carefully manage risk to any long positions. I've opened another position in the last 24 hours. Price has moved up and away now, and so I'm moving my stop on that latest long position up to break even to eliminate risk. My position I opened a few days or several days ago now at a lower price point. I've moved the stop up to protect just a small amount of profit, and so I don't have any risk to those long positions. That's quite a good risk management technique when the wave count's uncertain. The new wave count, the alternate, is different at the weekly chart level, and so to see the differences and judge which is more likely in terms of Elliott wave structure, we have to step back and take a look at the bigger picture at the weekly chart level. This is my preferred wave count because it meets all Elliott wave rules and it has good proportions. The best wave count I've been able to see for the movement from this high to this low is seeing it as a double zigzag. If that's a double zigzag, that tells us a couple of things about Grand Supercycle Wave 4. It eliminates a zigzag for Grand Supercycle 4 because within a zigzag the A wave has to be a 5. It also eliminates a combination or multiple within Grand Supercycle Wave 4 because you can't label multiples within multiples. The maximum number of corrective structures within a multiple is 3. To label multiples within multiples increases the maximum beyond 3, violating the Elliott wave rule. So that leaves two groups of structures for Grand Supercycle 4, either flats or triangles, which are really typical fourth wave structures and would provide alternation with the zigzag of Grand Supercycle 2. If Grand Supercycle 4 is a flat correction, there's a minimum requirement for the B wave up within it. It has to be a minimum 90% the length of the A wave, but I'm not putting that minimum on this chart because there's no minimum if Supercycle B is a B wave within a triangle, but it should be really deep. If it's a B wave within a triangle, it would be excessively unlikely to be over here. It should be much, much deeper than that for the triangle to have the right look. The B wave of either a triangle or a flat correction may make a new high beyond the start of the A wave at 1920.18, as in an expanded flat or a running triangle. So there is no upper invalidation point for this wave count, and we will be expecting a bull market to last at least a few years, if not quite a lot longer. In order for it to be very deep, Supercycle Wave B would most likely be a zigzag. It's very, very likely to be a zigzag. And so the first movement up is very likely to be a 5-wave structure for Cycle Wave A. It could also be a multiple zigzag. We could have W, X, Y, X, even a third one, Z, for a triple zigzag, although triples are really rare. But the most likely structure is a single zigzag or a double zigzag, and for both of those I would expect that the 5-wave structure for the A wave, the first A wave, would most likely be incomplete, and we would have primary 1, primary 2 and primary 3 still underway. Within primary 3, no second wave correction can move beyond the start of its first wave below 1200.07. Going back to the structure of Supercycle Wave A as a double zigzag, it all has a really good fit. We have a 5-3-5, the first zigzag and the double ends here. There's a ratio between A and C, and here's the only problem I can see for this wave count. Primary Wave B here technically is a running flat because intermediate C failed to move beyond the end of A. That does slightly reduce the probability of this wave count, but the proportions between A, B and C here are all really good. The double is joined by a brief shallow zigzag in the opposite direction labelled X. I have no problem with the brevity of cycle wave X here because X waves within double zigzags are usually really brief and shallow. This is where the second zigzag in the double would have begun, subdividing 5, 3, 5. Primary B here is an expanded flat, and primary C an ending contracting diagonal, meeting all Elliott wave rules, specifically the rules regarding wavelengths for a contracting diagonal. The third wave is shorter than the first, the fifth wave is shorter than the third, and the fourth wave is shorter than the second, and the trend lines converge. This all looks really typical, especially with a small overshoot of the fifth wave of the 1-3 trend line. All of the subwaves of this ending contracting diagonal subdivide nicely as zigzags. I don't have a problem here with A and C, being much longer than A. That's fine, they don't have to be equal. There is no ratio between the two, but all the subdivisions fit very well indeed. Let's have a look at this idea at the daily chart level, where primary 2 expanded flat correction ended here, and this is where primary wave 3 would have begun. At 1582, primary 3 would reach 1.618, the length of primary wave 1. If primary wave 3 has begun here, then I think it's so far the best way to label it would be an impulse for intermediate 1, a zigzag for intermediate 2, an impulse for minor 1, a zigzag for minor 2, and now another impulse for minute 1 and another zigzag for minute 2. So we would have 4 overlapping first and second waves up to here. Would be expecting quite a strong increase in upward momentum. But that doesn't have to happen right now, because gold's third wave impulses do quite often start out somewhat slowly, and when they do that, they give us quite a lot of confusion and try and convince us that we're not going to see a third wave, and that happens before momentum really starts to build. We'll have a look at an example of a third wave toward the end of the video. Now there is another alternate that I'm going to chart next and publish for you in next analysis. What if intermediate wave 1 wasn't over here but was over here? And this could be a 3, 3, 5 for intermediate 2 to move lower and find support at this lower edge of the maroon base channel, which I've drawn around primary waves 1 and 2. Now that is also entirely possible. If we see a new low in the next 24 hours, I will be charting and publishing that alternate, but for now I have an alternate that also expects downward movement. Let's just stick with one a day. Let's have a look at the hourly chart level, and I'm going to copy the cyan support line from this low to this low, extend it on out, copy it over to the hourly chart, where this high for minute 1 is this point up here. If this wave count is correct, then minute wave 2 really should be over as a 5, 3, 5 zigzag complete down here. Now if we have an impulse unfolding lower, we would label that 1, 2, 3, 4, 5. This sideways movement could be an incomplete fourth wave correction, which can't move what into what would be its first wave price territory above 1349.25. And so that's why if we see a new high by any amount at any time frame above this price point, we can have quite a lot of confidence in this wave count, because at that stage this could not be an impulse unfolding lower, because the fourth wave can't move into first wave price territory. I want to see this confidence point passed before I have good confidence in these targets and at the expectation of upward movement. At 1513, minor wave 3 would reach 1.618, the length of minor wave 1. While price remains below the confidence point, I'll leave the invalidation point down here at the hourly chart level as well, for the same reason as outlined on the daily chart. Here's an example of gold's third waves. Typical of commodities, it tends to have strong, swift fifth waves, and that tendency is particularly prevalent for gold's third wave impulses. They often end with swift, strong fifth waves ending with blow-off tops. Here's a perfect example. When they do that, the second wave corrections tend to be more time-consuming than the counterpart fourth wave corrections. So the whole thing starts out quite slowly with quite a lot of overlapping and choppiness, and then it ends with building momentum and building strength, finally with the strongest piece of movement on a very strong day, ending with a blow-off top. Or for the opposite in a bear market, a capitulation or a strong movement to the downside. So that gives gold's third wave impulses quite a curved look to them. We may very well be seeing that again. Sometimes volume can be a bit confusing in these second wave corrections. We might be seeing that again. So just be aware of that tendency. It's this tendency is the reason why I'm still publishing that main wave count as a main wave count. Here's a new alternate idea today. It sees supercycle wave A as a complete 5-wave impulse rather than a 3-wave structure, a double zigzag. If A is a 5, then B can't move beyond its start above 1920.18. B could be one of any of 23 possible corrective structures. Today, just to outline a possible bear market unfolding, what if B is over here as a relatively shallow and brief single zigzag? That is entirely possible, although it does look to be too brief for a supercycle B wave. It would be more likely that it would continue further sideways. But either way, for now, both of those ideas would expect some downward movement. But there are a couple of problems within this wave count. If supercycle A is a 5-wave structure, I would rather label it 1, 2, 1, 2, 3, 4, 3, 4, 5. In doing that, the ending contracting diagonal begins here, and so the third wave is shorter than the first wave. The fourth wave is shorter than the third wave. The fifth wave is shorter than the third. The fourth is shorter than the second. The trend lines converge. The rules regarding wavelengths for a contracting diagonal here are met. Now, I am aware that there are plenty of wave counts out there, and I think still possibly including Elliott Wave International, which sees this downward movement as a 5-wave impulse labelled 1, 2, 3, 4 as a triangle ending here, and the fifth wave contracting diagonal beginning here. That such a wave count, though, violates an Elliott wave rule, the rule regarding wavelengths of contracting diagonals. If the diagonal begins here, then the third wave is longer than the first wave, but the diagonal is still contracting, the fourth wave is still shorter than the second, the trend lines still converge. The rule regarding wavelengths for the contracting diagonal is violated. I'm still mystified as to why Elliott Wave International would publish a wave count which violates an Elliott Wave rule as laid out in Frost and Prechter. And this is a reasonable solution to that problem. But there are still problems with this wave count. There is the problem up here of gross disproportion between cycle wave 2, which would have been over in just 6 weeks, and primary wave 2, much, much longer in duration, would have taken 40 weeks. That gross disproportion between this second wave correction a degree lower than this second wave correction gives this part of the wave count a very strange look. If you were to draw a base channel around cycle waves 1 and 2, the upper edge of the base channel would run down here. Not only would primary 2 breach the base channel, but the entire following movement would be above and outside a base channel around cycle waves 1 and 2. Now, those are problems with the wave count that do not violate any Elliott wave rules, but they give the wave count the wrong look. You can make pretty much anything you like fit a price movement. If you ignore the right look, you can still make it meet most or all Elliott wave rules. It should always meet all the rules, but if you ignore the right look, you're pretty much guaranteed to have the wrong wave count. You do have to take notice of the right look, and this wave count does not. But we've avoided the problem of a violation of rules down in here. If we have 1, 2, 1, 2, 3, 4, 3, 4, 5, there's still a nice ratio between 1 and 3. We've got a slightly truncated fifth wave. We've avoided the problem of a running flat in here though, so that's a bonus for this wave count, but I have a really big problem with this gross disproportion. If we have a 5 here, then we could have a 3 complete here, subdividing 5, 3, 5. Let's have a look at this at the daily chart level, where this high is this point up here. So we have to see cycle wave C as 1, 2, 3, 4, 5. It looks a bit odd, but it will fit. If we have a trend change here, either it be at supercycle degree for the end of supercycle B or the end of cycle wave A as a zigzag, then we would need a reasonable amount of downward movement for at least a cycle degree B or X wave. We could have so far an impulse for 1, a 3, 3, 5 expanded flat for 2, and 3, a third wave would have begun here. So far we could have an incomplete impulse for the first 5 wave structure down, subdividing 1, 2, 3, 4, 5. 4 can't move into wave 1 price territory above 1349.24, I think it's 0.24, and that's why a new high above that price point by any amount at any time frame within the next day would give me so much confidence in that main wave count. When minor wave 1 is complete, if we do see downward movement, we'd then be expecting an upward correction for a second wave, which can't move beyond the start of the first wave above 1366.87. To the downside, if we see a new low below 1200.07, we would have some price confirmation of this alternate idea at the weekly chart level. At the weekly chart level, some classic technical analysis. As price is rising, as it rises, volume is increasing here and here, especially. As price is falling, mostly volume is declining, although important to note, for these 4 weeks of downward movement from price at the weekly chart level, volume did increase. So there was support for the fall in price here from volume, yet that was followed by a pretty strong upward wave to new highs. So the volume profile here you would have read as very bearish, especially when this week completed on light and declining volume. Even this one here, you would have read it as extremely bearish, and you would have been expecting a downward breakout to new lows. That's absolutely not what happened. Here's an example of why the volume profile is indicative and not definitive. We did have rising price, eventually volume did increase. Now we have a bullish engulfing candlestick pattern here at the weekly chart level, supported by a stronger volume for this upward week. Now we have a downward week coming on lighter volume. The fall in price last week was not supported by volume. At the weekly chart level at this stage, the volume profile looks more bullish than bearish. On balance, volume is constrained with resistance at the green line and support at the purple line. A break above resistance would be a strong bullish signal. A break below support would be a reasonable bearish signal. This trend line is weakened by a breach here, yet on balance volume returned above it. RSI at the weekly chart level is not extreme. There is still room for price to rise. Looking at the short-term picture at the daily chart level, the volume profile is concerning. Essentially, price has been range-bound since we entered a sideways range after this high here. We entered a range-bound movement on this day. During this range-bound movement, it's an upward day which has strongest volume. This upward day here, this one here, has strongest volume, and so that tells us an upward breakout may be more likely than a downward breakout. As price is moving essentially sideways, volume is essentially declining. Price is finding resistance about 1375 and support about 1305. On balance, volume trend lines have been redrawn today. A break above the purple line may precede an upward breakout from price. If that happens from on balance volume, that would be a strong bullish signal. Conversely, a break below the yellow trend line would be a strong bearish signal from on balance volume and may precede a downward breakout from price. RSI is just about neutral. There's room for price to rise or fall. ADX began declining back here. We had some increase here, but it's declining again. And so overall, for this sideways consolidation, ADX is overall telling us the market is consolidating. ATR agrees it's overall declining. So while price is range-bound and moving sideways, ADX and ATR, our trending indicators, are telling us this market is not trending, it is consolidating, and volume tells us an upward breakout is more likely. So if we are range bound, we can use stochastics and support and resistance lines with price to tell us what to expect next as most likely. The upward swing should have ended here when stochastics reached overbought and price was very close to resistance. A downward swing may now be expected to continue until price finds support about 1305 and stochastics reaches into oversold at the same time. And so that approach would fit the alternate Elliott wave count. It would be expecting overall downward movement for another week or so yet. That's all from me with your extra video update, and I hope that all of our members are having a fabulous day.